Thanks for joining us today on Market Call. I'm Marella Fernandez. Chris Blumas on the show. He's a portfolio manager at Raymond James Investment Counsel. He'll take your questions today on North American large caps. Here's how to reach us. Call toll free 1-855-326-6266. You can send an email, marketcall@bnnbloomberg.ca. Chris, thanks for joining us today. We have new manufacturing numbers out showing a 1% drop for August. Should investors be ready for more tariff upsets with the new duties on lumber and other furniture also coming into effect?
Well, I think, we started to see it. Obviously, there was, some of the earlier data, there was some pull forward of demand for different products. And then really what you've seen, even with the Canadian trade data, the August numbers were pretty staggering just in terms of the trade deficit. So you're starting to really see the impact and the bite of the tariffs.
Okay, so let's talk about volatility in general, because we do expect some volatility this time of the year. But what is your take on what we've seen so far?
It's like everybody's kind of sitting on pins and needles, right? There's just so much geopolitical tension right now. And I think, that's really what's captured everybody's attention. How will this play out over the long run? How long will the environment remain like this? But, then the flip side of what you've got going on geopolitically, you kind of preface that with what's going on in the technology sector, specifically in terms of, chip demand, the build out for AI. You've got almost like, a massive land grab that's going on right now. And it's massively expensive. So, you've got, different parts of the market that are pushing ahead higher. And the way that the indexes are composed, some of these larger companies are getting more and more fund flow. So I think, there's always nuances to the market overall, but I think this is more a continuation where there's just a few names that continue to drive the market.
So are you advising investors to stay invested or hold on to some cash at this time?
I don't do it quite like that. I mean, cash in the portfolios is a byproduct of opportunities within the markets. There's definitely some overvalued parts of the market, I think, but there's also some undervalued parts of the market. So there's about 50 names that I use or would be willing to use in client portfolios. There's about 30 names in kind of a standard portfolio. There's always about half of them right now would be within the buy range and half aren't. And this goes back to what maybe I mentioned a little bit earlier about the volatility. Just be patient because you may get an opportunity. So I think it's important to know what you'd want to buy, what price you'd want to buy it, and then you'd want to watch and wait. And, because the market is so volatile, you'll likely get a really good opportunity.
All right. We will hang on to Chris. We will be back with your questions and your emails for him. Chris is with Raymond James Investment Counsel. He's taking your questions today on North American large caps. Back in a moment. Welcome back to Market Call. Thanks for joining us. Let's go to Kyle's email. He says, any thoughts on Extendicare? We'll put that question to Chris Blumas, who's joining us now. Is Extendicare one of the stocks you follow?
It isn't one that I follow explicitly. Chartwell, one of its main competitors, I follow quite closely. So Chartwell is one that I've owned in the past. I don't currently own. And as a byproduct of that, I try to keep up on Extendicare as well. And so in terms of its valuation right now, it's very reasonably valued. If you look at kind of price to funds from operations, it's about 13 times. So I think it's very reasonably priced. What's unique about, say, Extendicare versus something like a Chartwell, very similar markets that they're in, but Extendicare is a corporation versus a REIT. So, in terms of what they pay out, it's roughly half of their funds from operations they pay out. So I think in terms of its valuation and business model, I do like it. And I think, why this one's had such a strong return, you look at the 5-year number, is really this was, the same as Chartwell is just bouncing back from the pandemic. So, in terms of, having good value, I think it does. It's not one that I own, and that's just a little bit, has to do with kind of the growth outlook for the company. But I don't see anything wrong with the valuation here.
Just out of curiosity, you said one operates as a REIT, one as a corporation. The corporation returns about half, I guess you said, the money. What does the REIT do?
Well, the REITs typically pay out more, or there's some punitive tax they have to pay. And I think what happens, I think that's a great question. And sometimes I don't explain it well enough on why it's important. But what happens with REITs, especially like, say, one like Chartwell, they're going to aggressively grow and grow. And that means they're going to develop projects, buy other companies. And then a downturn in the economy happens or COVID hits. And because they don't retain any capital, they're forced to raise equity. And, that's really dilutive for shareholders at a really bad time. You look at some of the lumber companies right now, and, a few of them have had to raise equity to kind of, keep on side their debt covenants and keep their credit ratings. But you don't have that same problem when it's a corp. And so I think my favorite name, which I'll talk a little bit later in the show, is Main Street. And it's a corp versus a REIT. But I think that's really, when you're in that corporate structure, you control your own destiny a little bit better.
Got it. Okay, let's go to the phone lines. Kevin has been waiting. He's in Belleville, Ontario, with his question today. Hi, Kevin.
Thank you for taking my call. My question's on Taiwan Semiconductor. It's reporting tomorrow, and I'm just wondering if you would be a buyer or would you hold off? Thank you.
Thank you for the question. We'll pull up Taiwan Semiconductor. A lot of these tech stocks have run up, right? Really did quite a run up since that April low. We'll pull up Taiwan and take a look at it if we can. But would you invest at this point in the stocks that have already sort of blown up this year?
I think like Taiwan Semiconductor is one that I do own in client portfolios, have owned it for the last few years. Really why the stocks have come up so much, like in Taiwan's case, it's been a combination of growth and multiple expansion. So, it gets right to your point that, if you do buy now, you're buying with significantly more valuation risk. And so, this isn't one that I've been selling for clients, but it's one that I've had to hold off on buying for new clients. And you're probably in less of a risky spot buying ahead. The numbers tomorrow are going to likely be quite strong. But Taiwan is a company that releases monthly, so they release these the monthly sales data. So there's a little bit less surprises with them. Typically, I don't buy into a release. Like I would just wait for the release and then kind of assess it. This is one though, because I knew what their last monthly release was. It's quite strong. Demand is insane. It's likely going to report quite strong numbers. The thing is, what you get into this kind of situation, okay, is that what the market expected? Is 30% growth not good enough, and the market was expecting 35 and it goes down? Like directionally, it's going to be a quite strong, a top line growth. In the end, I don't know if it will be, satisfy the market or not. But if you look at the valuation of Taiwan, it's come up quite significantly. So, the forward price to earnings multiple is kind of in that mid 20 times. So I think to me, that's a little bit rich, and I'd look to buy on a little bit more of a pullback.
Okay, and generally speaking, you said you don't buy in ahead of a release.
I don't, unless there's something very, very specific I think is going to happen. So it's not an absolute, like I've never done it. It's but I do it very occasionally.
Okay, let's move on to our next caller. Michael is in Vancouver. Hi, Michael.
Hello, Marilla. Hello, Chris. Chris, thanks for taking my call. Chris, a few years back, you had recommended a smaller cap Enghouse Systems. It has had a challenging last 24 to 36 months. I wonder if you're still holding it and if you're still optimistic about maybe a little bit of a turnaround story for this equity. Thanks, folks. Have yourselves a great day. I'll hang up and listen to your response.
Okay, thank you for the question. So Enghouse does software products. How do you feel about software right now? Some are worried about AI eating up that business.
Yeah, and I think when we don't know what the pathway is for AI monetization, any argument, if you look at the amounts of money companies are spending, the dollar figure is staggering. So, how is this going to impact life? It's likely going to impact the employment side of the picture, and it could impact other technology solutions, where it be software. But in the end, like, the massive spend doesn't make any sense if there's not a market application for it. So it's either going to replace people, or it's going to replace software, or it's going to be some combination of both. And I think there's certain software that is likely more susceptible to maybe disintermediation or being removed. And, if we get back to kind of Enghouse, it's not one that I own. It's one that I sold a while back. In the end, it just wasn't delivering, and kind of hit my down from loss trigger and kind of decided to exit. I think in terms of really what got me was just the lack of shareholder friendliness. You have a company that was sitting on a massive amount of excess cash, far more than they'd ever spent, and they just weren't using it what I thought was in the best interest of shareholders. So, I decided to sell and look elsewhere. So, it's not one. It looks very, very undervalued if you look at it relative to other, software consolidators, say something like a Constellation Software. But, its business is declining more aggressively, and they're not allocating the capital to new businesses as aggressively. So I think that's the reason why, and it could very well be a value trap. So that's one that I think I would stay away from.
Okay, if you already have it, would you sell at this point?
I did, but that was a while back. It really just depends on. So I typically use I do the full workup, down from cost review at 20%, right? So if you're in and around there, everybody has a different kind of cost profile. And, if you're down very big, and it's unregistered, there may be an opportunity for you to bank a loss. If it's, you're just slightly down and you're a newer investor, it may make sense to sit tight and watch and wait. Maybe there'll be a takeover offer. Maybe there'll be something that happens. But in that case, it depends on everybody's cost profile.
Okay, we will leave it there. I hope that gives some information to Michael if he wants to make a decision there. We're going to be back with Chris Blumas of Raymond James Investment Counsel. He's taking your questions today on North American large caps. Back in a moment. Welcome back. Thanks for joining us on Market Call. We have Chris Blumas with us. He's joining remotely as we take another phone call from Peter, who's calling from Niagara Falls in Ontario. Hi, Peter.
Hi, good afternoon. Thank you for taking my call. My question is on Suncor Energy. I'm looking at buying it for the dividend yield, and I noticed this morning RBC just rated it to a strong buy. Can I please have your opinion? I'll hang up and listen to your answer. Thank you.
Okay, thank you for the question. Suncor, obviously going through an acquisition as well. What's your take on Suncor?
Well, I think it's a very well-run company. So, for people who are looking for energy exposure, or people that are looking for dividends, Suncor and CNQ would be kind of my go-to names. I own CNQ in client portfolios versus Suncor. In terms of the valuations, they're very comparable. I think in terms of the operations, CNQ, there's a little bit more that they can do on the capital allocation side, where they can allocate among, some different asset classes. But I think, the new CEO, I mean, he's not new anymore, but he's done a wonderful job kind of making Suncor more efficient. And a lot of people are kind of in this day and time are a little bit more anti-energy. But some of these energy names, they just gush cash. And I think, that's what, my focus is. Generally, I'm a cash flow focused investor. And I think sometimes, just like your caller, the cash flows that these businesses generate and with their different dividend policies, they're so much more shareholder friendly now and wanting to allocate capital and return it to shareholders. So I think that's what catches my attention in this environment. And I think the second thing now is just if you look at the oil price and you look at the valuation on these companies, they're a little bit down on their luck right now. So I think, my preference is CNQ, but if you have your heart set on Suncor, I think it would be a quite a reasonable investment for a dividend-seeking investor.
Okay, let's move to an email then from Bill. Bill says, I've had Kushtard for a few years and have made zero capital gain. Is it worth hanging on for a long-term gain? Kushtard, of course, went after the 7-Elevens from the Japanese owner that spent some energy, but they didn't. They walked away, deciding that they weren't going to pursue it. And the company did sort of track downwards as a result of them trying to get ownership there. What's happening now, and is this a company you would hold on to for a longer term?
Yeah, this is one, like I'm a huge fan of Kushtard. I've owned it almost my entire career. So huge fan. I think the valuation is very attractive. If we go back to your comments about the potential 7&I acquisition, that really just spooked the markets. People didn't understand how could they do it without it being dilutive to shareholders. So there was a little bit of a sell-off related to that. And I think in terms of generally the excitement around Kushtard, there's not a lot of excitement right now just because, even in the U.S., there could be a little bit of economic weakness. There could be a little bit of an attack on discretionary income. But if you look at this business, it generates such massive cash flows. There's so many options. They can buy back shares. They can increase their dividend. They can do other acquisitions. So I think in terms of they're just so good at allocating capital, they'll find other opportunities. And if they can't, they'll just buy back their shares, which are trading at a good price. So I think, longer term, all of these different actions that I mentioned will likely give earnings per share a reasonable boost. So I think you've got good growth, maybe not AI type growth, but you've got good growth and you've got a business that's trading roughly around 17 times earnings. So I think, very, very reasonable price to pay for a high quality compounder.
Okay, let's move on to John then. John's calling from Toronto with his question. Hi, John.
Oh, hi, good morning. Thanks for taking my call. I'm calling about Dollarama. It's had quite a drop in the last month or so, and I'm just wondering if you know the reasons. And given the fact that it's back to school, Halloween, Christmas, this is usually a busy time for that kind of a store. I'm wondering if you could comment on that.
Okay.
Thanks.
Any trigger that you see, Chris, for Dollarama?
I mean, one of them was valuation, but I don't think that was it. I think it really is, look, like a lot of the stuff comes from China, right? So, if you look at kind of their sourcing and, that's kind of caused a little bit of issues. But the valuation has come up. This is a business that's trading, mid 30 times earnings, right? And this is a very, very unique business in Canada. And as Canadians are getting pinched, as the wallets are tighter, Dollarama, Walmart, you've seen the discount banners benefit massively. Costco as well. But if you look at all of them, their growth in earnings, revenue, almost every metric has been sensational, but the valuations are also sensational. So I think a little bit of a pullback could be on the valuation side. And, it's one I would love to own it. I can't come to grips with paying that valuation. But this is one, like I mentioned, on a pullback would be a great one to add to.
Okay, we're going to take a quick break. When we come back, we'll have a look at Chris's past picks. Back in a moment. Time now for a look at Chris's past picks from October 16th of 2024, so about a year ago. At the time, Chris, you picked Nike on the New York Stock Exchange, and at the time it was 83.94 US. It's down now to 69.30, so a drop of 17%, a total return drop of 15%. Nike's been going through a transition. Do you remember why at the time you decided to pick it up?
Yeah, I mean, when I did decided to buy, like, this was one that fits in the turnaround bucket, and this is one that actually I had earlier in my career had purchased as well, kind of on a similar plan. And I think with these turnaround type opportunities, this was one that I think my thesis changed, so I was getting close to my down from cost review. The thesis had kind of changed on Nike. And really the three things that I think kind of limit the upside on earnings in the turnaround scenario was, the tariffs. When they were kind of entering turnaround mode and their new CEO came on board, the tariffs weren't a thing yet. And then you've got some structural changes in their Chinese business that are going to be difficult to overcome. And the third thing is just really, anti-American sentiment. Those three things, when you kind of assess it, I thought limited the upside on earnings. And if you look at the current valuation and where I thought earnings could get to, those three things dramatically impacted it, which made the shares, in my mind, on the reassessment look fairly valued. And so when they reported their Q1 results, there was some mixed messages, some positive, some negative, but there was a pretty significant rally in the stock. So I just used that opportunity to exit.
Okay, so your thesis changed on that. Let's get to your next topic,
Yeah.
Alphabet, Google, of course, on the NASDAQ. At the time, it was 165.16 US, 247.02 today. So a 50% upside and a 50% total return upside as well. One of the Mag 7 stocks that have been on a tear this year. Is it something you're still holding on to?
Yeah, absolutely. Yeah. No, Google's Alphabet's been a core holding in client portfolios for a very long time. But in prior times, it was always, we could always get it at a discounted valuation. And most of my, say even the last 3 to 5 years, you could always buy Alphabet, for less than 20 times earnings. And, that's a massively attractive price for a company that just, it's a printing press for money. It has a debt-free balance sheet. It's very, very well positioned for the future. And it has a number of businesses that have massive value that they likely can spin off down the road. And I think, what you've got, why there was some value, like a valuation overhang, was just the antitrust sentiment, right? And so that was really the big catalyst recently where, the remedies, or what was kind of is going to be forced on Google, it appears to be significantly less severe than people were thinking. And so the stock, even within the last couple of months, had a really, really big push up. So it is one that I like a lot, continue to own it, but it's a little bit above my buy price. So it'd be one that, it's a hold. I'm not buying currently. Okay,
let's move on to your third pick from October of last year, Brookfield Infrastructure on the TSX. Let's have a look at where it is today, 49.49. It was 49.19, so a bit of an upside here, 0.6% return and a 5% total return. Why did you pick Brookfield Infrastructure among the Brookfields?
I always like to have one for income investors. And whenever I can, I know a lot of the viewers and a lot of people call in looking for income ideas. And I think this was one that gives you income and growth and, a really attractive valuation. So I think the thesis here is still intact. You only got 5% holding it for that year, and that was largely the dividend. But, that's why you'd want to own it. And I think, even as far as owning it today, it's definitely one that you would want to own for the future. Very, very, very inexpensive. So, it's one that I like and continue to own.
Okay, we will leave it there for Chris Blumas' past picks. We will come back, take more of your questions. Chris is taking your questions today on North American large caps. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. We're going to Alfred, who's on the line from Mountain View, California, with a question for Chris. Hi, Alfred.
Hi, Mirella. Thank you. Great show, as always. Chris, your thoughts on Berkshire Hathaway Class B shares, medium and long term? Thank you so much.
Okay, thank you for the question. Berkshire Hathaway, we will pull up, of course, with Mr. Buffett retiring, I guess, at the end of the year. What's your take on Berkshire Hathaway?
It's a business I follow very, very closely, and I have for my entire career. There's a lot to learn from a business like this. I think in terms of owning it within client portfolios, I don't currently own it, in client portfolios. I think the reason why is really kind of just capital allocation and kind of efficiency. There's always been some hesitancy to return cash to shareholders through the dividend. And this is a business that is designed to just aggregate cash, right? So all of the different operating subsidiaries spin off cash. But as it's gotten bigger, it's hard for it to find acquisitions that are meaningful. So that in a situation like that, the best thing would be to repurchase shares. And that's something that they've never really done significantly. And I think as a result, that's why share price performance for Berkshire has tended to lag. But, recently with some of the volatility, there has been a flight to some more defensive names. So in names like Berkshire in the P&C space have been a beneficiary of fund flows, and that's really pushed up its valuation. So it is one that I like quite a lot. If there is a lot of negativity in the market, it will likely operate countercyclically. Like if the market sells off, it will likely go up. Just because of that cash pile, they're very well positioned to kind of consolidate competition. And I think that's what it's always been designed to do, right? It's always been designed to be counter-cyclical, but the flip side is we're kind of entering an environment that may be very needed, but then the valuation's up significantly.
Has there been any discussion from the company, from the firm, as to whether or not it would start paying a dividend to investors?
No, they're going to do what they're going to do, and I think the way that the succession plan will unfold is, Warren Buffett's son will go onto the board and have a significant influence, and I think the way that things get done will likely persist for quite a bit. But you can see that there's significantly more value in the sum of the parts versus the whole, and I think. The modern day Berkshire Hathaways for me are the private equity firms, the ones like KKR, the ones like Brookfield, because they're doing a very, very similar strategy to what Berkshire did, when it was smaller and younger. But then they have quite good infrastructure and are able to leverage that a little bit better. So I think that's where I've gone instead of allocating to something like a Berkshire Hathaway.
Okay. Let's move on to another phone call. Ghulam's on the line from Toronto. Hi, Ghulam.
Hi, good afternoon to you both. My question is on TELUS Corporation. I understand the dividend yield is at about 7.5% or a little bit higher rather than putting money into a GIC. What's your recommendation? Should I go in at this current price? I appreciate your comments. Thank you.
Let's have a look at TELUS. The telecommunications space, we know, has been challenged. Do you have investment in any of the telecommunications giants in Canada?
I don't have any investment in TELUS. For some clients, I do have an investment in Rogers. And, I've been pretty vocal on my outlook for growth within this sector. This is where this sector struggles, right? It's a domestic industry that generates good cash flow. There's been more price competition in recent years, so the margins have been hit a little bit, and consumers have benefited from more competitive products, and that's been great. And I think in terms of TELUS is always kind of the premium valuation in the space, partly because of their leadership and partly because of their focus on Western Canada. They've also done fairly well kind of allocating to some businesses outside of their kind of core. So I'd say, like, for people looking for growth, this isn't a sector or you want to look to at all. But for people who are retired, who are looking for income, I think you do want to look at this space. And I think the one that I chose was Rogers, just because to me it's value. It's 10 times earnings. It's the lowest valuation of the peer group. Partly it's because of the multiple voting shares that unlikely to change. But there's massive hidden value with their sports assets. So you're going to collect, a pretty robust dividend. If they ever figure out something to monetize these and have shareholders benefit down the road, there's a lot of hidden value in something like a Rogers. So I think in this situation, my preference is Rogers over TELUS.
Okay, Gulam, I hope that helps you out. We're going to take one more email here from Patrick. He says, I've held Moderna for the past few years, watched it steadily fall. Is there any hope of recovery from this stock? A lot of the pharmaceuticals, healthcare in general, beaten down, Chris, this year. Some of them are beginning to revive a little bit. A lot of pressure from the U.S., of course, from Donald Trump and that administration. Are you looking at any pharma? What do you think about Moderna?
Yeah, so, this one is... the technology that they have, you saw kind of coming through COVID. If we find here a 5-year chart or even a 10, this, it goes parabolic and then it gives it all back. And I think this is, the market or investors are always willing to kind of invest, and they're looking for the next permutation of their technology. Can they apply that to, alleviating some cancers? Can they apply it to, is there kind of adjacent markets that they can attack with their technology? I'm not an expert in biotech. I don't know how you can handicap that. And I think that's why generally biotech, it tends to be a very binary business. Like it either booms and you hit it, or they go, they aren't around. So for me, it's not something that I'm comfortable participating in. If you look at some of the other maybe competitors in the pharmaceutical space, that's been one area that there's just been so much political rhetoric and pressure to kind of right-size prices. That's the reason why I haven't been there. So, the parts of the healthcare sector that I've, been willing to be in is more kind of on the device side. Abbott for me, a diversified kind of device company, and Alcon who focuses on eye health. But, it's tough for me, the Moderna to tell your viewer, like, it would be a good buying opportunity. It's one, to me, it's just too difficult to handicap. So I just stay away.
All right, we're going to take a quick break. We are going to be back with Chris Blumas, Raymond James Investment Counsel, taking your questions today on North American large caps. We're back in just a moment. Welcome back to Market Call. Chris Blumas here with us today to answer your questions. Let's go to Sal in Vancouver. Hi, Sal.
Hi there. Yeah, my question is on Topicus. Topicus, Lumine, and Constellation have all taken a hit over the last few months, probably on AI jitters and whatnot. So I was curious to know that there is some concern here based on their business model for these consolidators, and could it affect them? And what would be your thoughts on Topicus in relation to that?
Okay, thank you for the question. Chris, again, a software company, like many others, with concerns about AI taking over and there no longer being a need for software. What's your take on Topicus?
Yeah, so this is one that I own. I didn't explicitly buy it. As it was spun off from Constellation, I just held it. So it's one that I haven't added to, but I kind of think of it as part of kind of the investment in Constellation. They chose to kind of spin off Topicus to kind of incentivize, manage it, and give them their own runway. In terms of adding to it, I haven't. I tend to focus more on Constellation just because it's larger cap and there's more liquidity. So I do really like Topicus. I do really like Constellation. I think in terms of the fears around AI, like I mentioned earlier in the show, we don't know how AI is going to be monetized. So if you don't know how it's going to be monetized, you don't know what it's.
Okay, it looks like we might have a technical problem with Chris. We will try to reconnect with him in a moment. We're going to take a quick break. Back in just a second. Welcome back. We've reconnected with Chris Blumas. We're going to take a couple of emails to start. Brendan has said, looking for thoughts on Intact Financial Corp and its recent drop. Intact, of course, has insurance. Chris, tell me about any reason you see for the drop that it's had recently. We'll pull up the chart in just a second.
No, this is one too. This is like I mentioned with Berkshire Hathaway, the PNC. Typically, it's a counter-cyclical. People tend to rush into PNC insurance. It tends to be a little bit more counter-cyclical. So that's why this one has kind of come off. If you look at the valuation now, very, very reasonable valuation. What really kind of the hang up for me, why I don't own it is just because of the growth outlook. They're becoming more and more and more like they have the largest market share in Canada. And so for them, it's always okay. They've gone to some international markets to keep growing. But, that path is a little bit less uncertain. So I think in terms of kind of the hang up for me is just on the growth side, but a very, very well-run company, reasonable valuation. So, I mean, if you have your heart set on this one, it's a good company.
Okay. Let's go to Josie then. She says, please ask your guest about Intel, buy, sell, or hold. We will pull up Intel in just a moment. What's your take on Intel?
Yeah, I wouldn't go there. I just wouldn't. You don't have any need to go there. There's been a lot of positive news around Intel, and really it's just geographic. Like Intel, they care a lot in the U.S. because they're looking at Intel to kind of be a U.S. manufacturer of chips, right? Like Intel lost its crown, from kind of the PC chip king, and now as you go to AI, their chips are, less well suited. Like NVIDIA kind of took that crown, so you don't need to go there in tech. I think there's look for Taiwan Semiconductor, look at ASML, look at NVIDIA. Those would be three that would have a much higher preference to be invested in than Intel. Intel is going to get some government support because they need to have, an American chip maker, but that's really lucky for them that this hit them at the right time, because this was a business that was floundering. This would be the third permutation of their turnaround, and I just don't think you need to take the risk to go there.
Okay, good to know, because there were some questions, right? Once they got some U.S. government funding as to how far that U.S. Government support would go and maybe push Intel a little bit up. Okay, let's get to another email from Greg. He says, would like your thoughts on Merck, healthcare solutions company. Tell me about Merck and whether you would, first of all, invest in the space.
Yeah, and this was similar to my comments that I mentioned on the U.S. pharmaceuticals. There's so many of them that look so inexpensive on a price to earnings basis. These businesses are mature. They have weaker product pipelines, but they do generate a significant amount of cash. The flip side is they don't grow, right? And so I think the way that the costs have risen, just to get through the different approval for each phase, with the FDA, it just makes drug development so much harder. And so I think this is a space that as a Canadian, you're going to go to the U.S. or you're going to go anywhere in the world to get things you can't get here. And, to me, healthcare is one of the sectors that you're going to go to the U.S. and get, because we just don't have enough. But I would prefer something, like an Alcon or an Abbott or a Boston Scientific. There's just companies that we can go invest in that just have a much better growth profile. And that's why I'd prefer them to something like a Merck.
Okay, let's get to your new top picks then. We're going to start with Constellation Software on the TSX. And I want to ask you a couple of things about it. First of all, we know that this is a company that likes to buy other companies and then sort of holds them maybe overseas. And you get to a certain point where how much more can you buy, or what is left for you to buy when you're a company that is now as big as Constellation Software? Why have you put it as one of your top picks? What are you seeing?
This is just a phenomenal compounder. It could likely be the best compounder kind of created. Software is a phenomenal business. this, you think of it as one company. This is not one company. This is 6 companies because, they have 6 different operating subsidiaries that do something very similar. And they are the master of the small deal. And that's how they get, such attractive valuations. They're buying things other people don't know to buy. And that's how you can buy something at 4 and 5 times cash flow. And so their whole infrastructure, this is really a private equity firm that focuses on software. And, with the fears over AI and partly the company's communication in a conference call surrounding AI, the stock had sold off. And I thought this was a great opportunity, to kind of step in and buy, very, very attractive multiple. The multiples reverted right back to their 5-year medians, which gives you a great opportunity to get in it. And you're going to get some solid growth, and there's a higher likelihood of multiple expansion. So this is one that I do like and would be happy to buy today.
Okay. And again, the software concerns aren't something that bother you moving forward for Constellation Software.
No, sorry. I kind of elaborated on this, but we cut out before. With them, this is a kind of a combination of 1,000+ businesses. If AI disproportionately impact 1 or 2, it wouldn't take down the ship. And I think this is a lot different scenario than, say, something like an Intuit or a Salesforce or something where, they have just a couple products. They could be a single product company or 3 dominant products. In that case, it's harder for your business to get around that. Constellation, where it's a sum of 1,000 very, very small software operators, there's much more better embedded defense against AI.
Okay, let's get your next pick then, which is Main Street Equity on the TSX MEQ. What do you like about Main Street?
Yeah, so this is similar to some of the points I mentioned before. Like, this is a really unique business. This is one of the best compounders there is out there, and it's definitely the best real estate compounder there is. And so, if you look at the markets that they kind of target, mid-market, a lot less competition there. Sometimes there's no competition from there. And, really unique business model because they're a corp and they retain that cash flow and look for other acquisitions. And then they're vertically integrated because they have a critical mass in terms of units. So I think this is one that is an unbelievable compounder. It's trading around 15 times earnings. You do have to be cautious when you buy it. Like, this isn't one you just put in the order and buy. You should buy with a limit just because it is a smaller cap company, but more than half of the shares are owned by insiders. So, just be careful on kind of the entry and the exit here.
Okay, let's move to your third pick, which is Honeywell, HON on the NASDAQ, which you have mentioned is going to spin off some of what it owns to sort of better focus. Is this part of what you like about Honeywell moving forward?
Yeah, this is a special situation, right? If you're looking for something with a catalyst, this is something, very, very inexpensive, 19 times earnings. It's got some great businesses under the hood, in terms of, aerospace and automation. And so what's going to happen to this business over the next year or so is they're going to start to separate all of those different businesses. So, that will be the catalyst for value realization. And as each of these companies become an independent company, their valuations will normalize to what's suitable for their growth and the industry they're in. So it's one that I can see in an awkward environment, lots of value, but then some catalysts to realize that value over 2 to 3 years.
Okay, I'm going to leave it there, Chris, because we are running out of time, but appreciate your time. Thank you so much for joining us on the show.
Oh, thank you very much for having me.
All right, and join us tomorrow on Market Call. David Burrows will be on the show. He's President Chief Investment Strategist at Barometer Capital Management, and he'll take your questions tomorrow on North American large caps. That does it for us here on Market Call. Thanks again for joining us. We'll see you again tomorrow.